Good morning, hello and welcome to Trading Hour. I'm Surabhi Upadhyay. With me as always is Reema Tendulkar, and what we've got is a very quiet, flat market. A market that's bracing itself for impact, shall we say, with the exit polls coming in tomorrow. For the time being, the Nifty is virtually unchanged, just about 18 points on the green side of the screen, given the kind of sort of drubbing it's received in the last couple of sessions. Bulls are trying to maintain an even Steven around this mark. The fight has been around the 20 DMA for the past couple of trading sessions, and today is no exception. The difference is yesterday, remember, at this point in time, banks were still trying to offer a lot of support, but that's also missing right now. The Bank Nifty also extremely flat, and the mid-cap market is showing slight underperformance. Mid-cap index down about 0.4% right now. Hi, Reema.
Hi, but the model looked more promising, right? The Nifty had a gap up opening. The high today on the Nifty was 22,650. So from that level, we've given up about 150 points in the Nifty. And as Surabhi pointed out, the 20-day moving average is very crucial. And that currently stands at 22,474. Lots of cues to watch out for over the next 2 days. So today is the MSCI rebalancing. India is likely to see $2 billion of inflows, and stocks are reacting. Take a look at something like Torrent Power. That's already up close to about 4.5%. It's likely to see inflows on account of MSCI rebalancing. Q4 India GDP is today. Tomorrow you've got the May auto sales numbers. And of course, the all-important exit polls also start trickling in 6:30 to 7:30 p.m. PSUs are correcting quite a bit. So while the Nifty's lost about 2% this week, the Nifty PSC index is down more than about 4%. And even names like Bharat Dynamics, where the numbers look good, margin improvement, profit jump, but the stock is under pressure. And another one we'll discuss in greater detail will be Zomato. After a near 180% rally in the last 1 year, there is Macquarie, which sees a downside of close to about 50% in the stock. 96 is the target price they've set on it. We'll talk more about it, but for now, let's talk about Bata. They've reported a soft Q4, tepid revenue growth of 2.5%. EBITDA was flat. Profits came in marginally lower. The company said demand conditions remain sluggish, but they're hopeful of a revival. Mangalam spoke to the company's MD and CEO, Gunjan Shah, on the quarter gone by, and he also asked him about his prognosis of the demand situation.
It's been tough trading conditions, right? Not only this quarter, but for now several months running. And this quarter, though, was showing some signs of revival. So, the exit of the quarter was better than what we entered in January, etc. But yes, it's been tough trading conditions. Within that, I think 2.5% growth has been something that we've seen after some time. So that's good to see. And we are hopeful that this continues going forward. Obviously, within this entire ambit, our agenda that we had in terms of driving portfolio evolution, making sure that we drive sneakerization as well as casualization and expansion of our network, both in terms of exclusive outlets, brand outlets of Bata, both COCO and franchise, as well as digital and MBO presence continues, and that we have continued to expand and invest for the future. I think what we also did during this quarter and has given us some very good, feedback, etc., has been 2-3 large initiatives. One has been continuing invest behind the Bata brand. We launched and ran our campaign on 10 on 10, which is footwear that you can wear right from morning to evening for formal as well as informal occasions. And that gave us some very good feedback from a consumer perspective, etc. Backed by obviously great collections, some of it you see in the background here. Besides that, we continue to invest behind some of our quote-unquote power brands. Power itself, it grew much better in double digits in this quarter, as well as floats. And floats continues to expand extremely fast. Now we are there across our network, and we have now opened the floats doors itself, which are at about a dozen doors.
Right. So we will talk about all of that in just a bit in detail. But until we do that, let's drill it down to the basics, the numbers. Some of your peers have guided for double-digit revenue growth in FY25, hoping for some recovery. You said that there was optimism towards the last month of the previous quarter. Can you go out and say that maybe double-digit is not ruled out for this year? Is that a possibility?
No, definitely not ruled out. But it's, as I said, we have got to see a longer horizon. While I said we did see improvement during the quarter, but we got to see how it juxtaposes throughout a period of time. And therefore, we'll be cautiously optimistic, Mangalam, going ahead.
What is cautious optimism when it comes to numbers? Is it 8%? Is it 10%? Is it 12%?
I will refrain from giving you a forecast as usual. But as I said, I'll still maintain cautious optimism.
You spoke about, store expansion. Your network is close around 1329 company-owned stores. I believe you have over 500 franchise stores as well. You had this target of 2,500 stores by FY26. Is that still on the cards?
You're very good at setting targets, and I need to include you on my board. But jokes apart, I think there is a continuous expansion last year also. While, as I have mentioned continuously to several of the audiences, that we will have expansion which will be in the range of about 100 to 150 stores every year. And even last year, we added almost about 140 stores with a ratio of bent towards franchise, which is about 80-20. So that agenda will continue and maybe accelerate going forward. So we continue to add even about 30 plus stores even last quarter. And I think that was relatively a little muted, but we will see a ramp up averaging out in this quarter and going forward. So expansion agenda will continue.
One of the interesting things about your business, even as you have almost 1,800 stores right now, is the renovation and sneakerization of the stores that you're doing. So I wanted to understand the economics of the same. How much does it cost to renovate a certain store? And what's the increase in revenue, throughput, and earnings from that store post this renovation, so that we know what the headroom is as you sneakerize and renovate all your stores?
So, no, renovation has been a very big agenda. I have commented on it in the past. It's a journey of several years. Now, almost 60% of our network is renovated in just the last 3 years post-COVID. And that obviously the endeavor is to deliver a much more premium, a much more consumer-friendly environment and experience to consumers. Involves many elements, right? I mean, in terms of the branding elements, right from outside the door and the facade to digital screen inside, the layout of the store, as well as, lux levels and lighting. All of it endeavor towards basically making sure consumer experience gets enhanced. We have, as I said, now got almost 60% of our store network renovated under what we call as RED 2.0. This journey will continue. We've been very aggressive on this compared to even opening COCO stores, right? And from an economics perspective, in a very simple way, the renovation, depending on the store, varies between a cost of 2 million to 5 million per store. So that's a significant amount of investment that we put in. The payback comes through in terms of much better premium feel, a premium selling, as well as in terms of basically overall growth of the store. We expect a renovated store to deliver us basically delta to rest of the network, almost 500 to 1,000 basis point extra growth. And that more than makes up and delivers great payback in terms of financials. And that's broadly how they...
That's interesting. And what about these standalone brands that you're talking about, leveraging the power of, say, you have floats and also power. You started your first power EBO. What is the average revenue of a power EBO, or any EBO for that matter, as against the entire universe of Bata?
So Mangalam, it will vary, and will vary by the concept, will vary by stabilization, not only of a franchise, like a power EBO is a franchise that we are creating outside the Bata store, but also by time, right? It develops a habit from consumers, etc. A lot of almost 70% of our consumers are regular consumers who come repeatedly to our stores. And so that takes time to build up awareness, etc., that we do. But however, as I have mentioned at the start, and we will continue this journey, we've got almost a dozen doors of floats opened. These are pop-up stores that we are doing, and we are looking at now as the floats range expands. The floats is on a very aggressive run rate of growth, etc. We will want to even open EBOs under floats, and we will share with you as and when we do that. In addition, obviously, as you rightly mentioned, and we have released it, last quarter, we opened our first EBO of power. Very exciting and promising new initial results that we have seen. Also, the kind of differentiated offerings that we are able to provide there with, exclusive focus only on sneakers and performance sports, etc., along with apparel, I think is something that we are looking forward to. Good initial signs.
Are you comfortable on margins at around 23%, or do you see scope for further improvement there?
There will be scope for improvement as we see more momentum on the turnover, because leveraging fixed costs comes through. What we have been good at till now, and I think that's something that we have made good journey on, is making sure that our gross margins and leveraging good cost synergies, etc., have been protected. So as we are able to get better turnover leverage, we should be able to see net margins also improve. All
right. One would assume that there would be a couple of 100 basis points improvement, at least in FY25. But since you, accused me of setting targets for you guys, let's wrap it up on this question that I asked you when we first spoke. the possibility of 5,000 crores by FY25 looks a little difficult right now, given the sort of environment that we were in FY24. So should we push it to FY26, and does that remain aspirational?
I think the point is that we see these cycles turn, Mangalam. I am very optimistic of the India story, and I don't see a reason why at some point in time we will start seeing this turn, hopefully sooner rather than later. And we will then want to see how we can reach the landmark of 5,000. Obviously, the ambition is on the table.
That is barter for you, not ruling out a double-digit revenue growth in FY25. There is scope for margin improvement from current levels, and the management also guiding for store openings of about 100 to 150 every year. The stock is up 1.5%. But let's get to the other movers of the day. Welspun Corp has slumped after a weak quarter. Nigel is here to take us through the Q4 earnings fine print. Nigel.
Well, that's right. Welspun is under some pressure, but just keep in mind the stock has been a big gainer. So some part of the street is sitting on big money. Now, in terms of the numbers, they're quite disappointing because there was a degrowth on the EBITDA front. And if you look at the margins, well, they came at around 7%. That compares with a double-digit margin, both on a sequential basis as well as on a year-on-year basis. What didn't work for them? The other expenditure, that was a little bit higher. The employee cost was higher. The gross margins as well did see some bit of compression. So that explains why, in fact, the margins did see some compression. But the PAT number did show a growth of 20%. That's because other income was higher, finance income was lower. And also they have a 30% stake in the Saudi Arabia facility, the associate company out there. And the profitability out there was much better. So that explains why the profit number looked much better, though the EBITDA number was under some pressure. In terms of, the debt number, well, it's come down drastically. They have been guiding that the debt comes down. It's come down by close to 1,000 crores in the past year or so. They have some capex plans as well going ahead. So we'll have to see how that shapes up. And for the next year, they have guided for around 17,000 crores of revenue and EBITDA number of around 1,700 crores. For the time being, the street is not too impressed with these numbers. Back to you.
Okay, the other stock which is on our radar and under pressure is Ipca Laboratories, down close to about 5%. Following the Q4 earnings call. Sudarshan joins in with the key takeaways. Sudarshan.
So in the last 2 days that since Ipca announced earnings, the stock has fallen more than 10%, including today's fall of almost 6%. But if we talk about the con call takeaways, it's looking largely positive. Company for FY25, standalone revenue growth is seen in the range of 10.5 to 11% versus 6% that company reported for FY24, and standalone EBITDA margin is seen at 20.5 to 21% versus 19% in FY24. On consolidated basis, EBITDA margin is seen at 18% versus 16.7% in FY24. Talking about segments, domestic business and exports are expected to deliver the same growth that the company saw in FY24, but big gain is expected in institutional business. It's seen growing at 14% in FY25 versus the company reported fall of 20% in FY24. Even API business is seen growing in the range of 7 to 8% versus fall of 9% company reported in FY24. Even brokerages are positive on the stock, and most of the brokerages have raised target price. DAM Capital maintains buy rating and target is raised to 1400 from rupees 1293 per share. JM Finance too maintains buy call and target is raised to 1365 from rupees 1280 per share. And even lastly, Nuvama has raised target price. Nuvama has cut the target price, but it's above 1400 per share.
Okay, all right, got that. Thank you very much, Sudarshan, for the details there. So, Ipca, largely positive sort of take from brokerages, but the stock is under pressure. We will take a break on that note. On the other side, we will be in conversation with Abhinav Bharti from JP Morgan to talk about the big buzz on Deal Street. Lots of block trades, lots of PE, MNC and promoter exits. What's the outlook for the rest of the year? We'll find out. Welcome back. Just noticing the buzz on the Adani Group stocks today. The market, by the way, Nifty's managed to pull back to about a 45-point gain right now. Adani Enterprises is the big leader, 3.5% up on Adani Enterprises. And Ports is keeping it company, about 1.5% up on Adani Ports as well. Other than that, you have a couple of financials that are looking strong once again. Bajaj Finance and Shriram Finance from the NBFC space. And then there is HDFC Bank. It's a bit of a lone ranger today. Bank Nifty is still fairly quiet, but HDFC Bank is trying to push through. IndusInd Bank is now trying to pull its weight on the green side of the screen as well. So some of these banking stocks trying to offer a little bit of an upside. However, having said that, I mean, there's still plenty on the downside. Look at Axis, look at SBI. So trends are very mixed on banks. That's the short point today. So not really getting too much of traction. I guess it's not really making much headway, Reema. I mean, the flat trends are really negating each other. I guess just nerves ahead of the big event.
Nerves. And, today Rohit Srivastava was saying is that it's possible that the market is just pricing itself for a no event. Right? It's an election verdict which is unlikely to throw any kind of surprises, and it's going to be business as usual. So there is a possibility of that. So we'll have to see how this, one plays out. Another word that I heard is that maybe we have a frozen verdict, which means unchanged from the last time. But let's get to Bharat Dynamics. That's under pressure, despite posting a strong set of Q4 numbers. Upasana joins in with the highlights there. Upasana.
Companies reported a strong set of numbers in Q4 FY24. Looking at the revenue growth, while it was single-digit revenue growth of 7% on a YoY basis, but PAT and EBITDA saw a sharp expansion. The PAT was up by almost 89% on a YoY basis, and EBITDA was up by 75% on a YoY basis. Well, reduction in finance cost and higher other income growth has aided the PAT growth overall. Now, coming to companies' EBITDA margins, they have expanded sharply from 23% to 37% on a YoY basis. Now, looking at companies' overall FY24 performance, the revenue saw a downtick of 5% on a YoY basis. Well, this reduction in turnover is mainly on account of the geopolitical situation prevailing in Europe and Middle East, impacting the supply chain of the companies, what the company has indicated. Coming to margins of the company, they were expanded sharply on a full year basis from 16.5% to 22.8%. PAT has also seen an uptick of 74% on a YoY basis, and looking at the order book, it stands strong at 19,468 crores. So all in all, we are seeing a strong set of numbers coming in from Bharat Dynamics, and I expect the stock to open in green today.
Okay, thank you very much for that. Well, the stock is now not in the green, but it's actually down close to about 2%. We'll slip into a very short break. On the other side, we'll also discuss market technicals. Sachitanand Utekar joins in next.
Welcome back, and let's get to that promised conversation with the experts at JP Morgan, the rise and rise in block trades. So the deal street has really been buzzing, and in a minute we'll just have Abhinav Bharti, Managing Director and Head of India ECM at JP Morgan, joining in. But first the number, and the number is really important to note. I mean, look at the pace of activity. It's frenetic activity. 14 billion was the whole value of block trades in the previous calendar year 23. And in 24 so far, we have already crossed 10 billion. And the last 6 months obviously have been extremely hectic with that number of 12.5 billion, which is on your screen. So as promised, let's try and understand what all of this signifies and what lies ahead. We do have Abhinav Bharti, Managing Director and Head of India ECM at JP Morgan, to take some questions. Abhinav, great to have you on the show. Thank you so much for joining in. So I suppose you've been really busy over the last couple of months going by those stats.
Indeed, it's been possibly one of the busiest times that I've ever seen in my experience or the time that I've spent in capital markets. There is certainly a lot of excitement about India at this point in time amongst both global and domestic investors.
Sure. So, Abhinav, at the secondary market level, we've been debating this for a while and asking a lot of market participants what it signifies. This rise in blocks and a lot of the exits, these are intelligent investors, so to speak, that are exiting, whether it's PE, early stage PE, or MNC promoters or Indian promoters. What does it signify? Does it signify a maturing market, or does it signify some sort of a top with respect to valuations?
No, I think, look, each of the different classes of potential sellers have different reasons or rationale as to why they have to undertake this. If you really look at it this year, the largest parts of or segments of selling has come from either MNC clients or private equity clients. And from whatever we hear, at least from the private equity clients, India has been one market where they're able to show monetizations, which as part of their requirements for their LPs is something that they need to do. It's an only market where liquidity has been available at decent valuations, and therefore, to that extent, block trade activity has been at a heightened level. At the same time, there are no alarm bells in my mind because they're equally raising larger and larger funds, which are focused on deploying into India or have a significant allocation towards India. So it's a cycle that is actually, I would argue, is getting played out in a manner in which it is supposed to be. There's recirculation of capital properly in the ecosystem. When it comes to MNCs, what we are seeing is or noticing is that it is what I would call it as active portfolio management from their perspective. It is corporate finance 101 that if you need to if you have cheap stock available or to buy back for the parent, you would essentially look at raising capital from your subsidiaries where valuations are quite decent, which invariably happens to be in India, which generally has a further premium for MNCs. And we are seeing some of that happening. But again, I would argue that given the fact that some of these MNCs have started to evaluate doing IPOs for their subsidiaries in India, there's no lack of commitment towards their Indian operations at this point in time.
Abhinav, morning. Can you talk to us about the pipeline and how might H2 look vis-a-vis H1? Is it going to be as robust? And was election, even a consideration in the closure of deals?
It is. Election is certainly a big factor. In fact, if I may give you some numbers, 2021 was the previous high when it came to IPOs. We had raised about $16 to $17 billion in IPOs that year. Average deal sizes was about $400 million. Since then, the average deal sizes are more, or for IPOs are somewhere between $200 to $250 million, if that's good. The pipeline that we are seeing currently at this point in time for us as well as for the market as a whole is closer to $20 billion of mandated pipeline, and there is more that we expect to get mandated to banks in the next few months. And in likelihood, the average deal sizes will start moving towards that $400 to $500 million on average mark, some of them actually topping $1 billion as well. That clearly shows that, number one, the momentum on this side is quite high. Equally, at the same time, the election part of what you raised is the key reason why a lot of issuers have waited for bringing their larger size capital raises post-election, and you would start seeing them hitting the market. Mm-hmm. But yes, given the pipeline, very likely that this could be a year where I wouldn't be surprised if we eclipse the 2021 high of IPO capital raise. Forget about the total capital, that certainly will be the case. But even for IPOs, we may actually eclipse the 2021 number.
Abhinav, the 20 billion pipeline number that you just spoke about, that's for secondary block trades, exits, or does it also include primary fundraise?
This is only and only primary fundraise for through IPOs.
Okay, so primary
and others is all on top.
Oh, okay. So primary fundraise alone, IPOs alone is 20 billion, and then over and above block trades. On block trades, I mean, what do you expect on the intensity? Will it remain as high as what we have seen? And also, what about the absorption power? I mean, I'm guessing a lot of the buyers are domestic institutions, domestic mutual funds, right? What's the sense you get from that side, given the retail flows?
So some of the larger ones have already taken place or got executed in the first half of the year. My sense is the activity will remain high. These may be, not necessarily very large block trades that happen. I think the second half of the year, in our view, could well be driven, like I said, by IPOs. But the run rate for block trades could still be pretty high. In terms of, sorry, what was your second question, Sulpi, if I may just ask again?
In terms of the absorption from domestic institutions, mutual fund investors,
yes.
Sort of whether that you expect that to remain as healthy as it has been.
Nothing as of now gives us reason to believe it otherwise, because if you really look at the inflows that are coming into the market, and we should not just think of it only from mutual funds, because in my view, the inflows into the market, at least from the domestic side, is a much broader set. So we talk about SIPs, which get the most amount of attention in the media, but the discretionary flows into the mutual funds, the direct flows through retail, and then other pockets like pension funds, AIFs is all on top. My sense is that the number from this set is possibly equal to what the SIP flows at this point in time are. So from that perspective, the inflows into the mutual funds or coming from the domestic savings ecosystem will remain high. I also believe that I think once the election outcome is in place and the event risk is out of the way, very likely the FII part of the equation, which has generally been a lot slower this year. In fact, at this point in time, year to date, they are pretty much flattish to slightly negative when it comes to flows into the country. I think that part could also start turning the wheels in the right moment.
Getting back to that mandated pipeline of $20 billion for primary fundraise, Abhinav, could you share some names? Because, for instance, Oyo IPO has been delayed. There is Swiggy, which is, announced, filed its DRHP for an IPO. So they're looking to raise some money. So what are the big ones that we should expect, where perhaps in the next 12 months? And what's the appetite now for these new age companies?
Yes. So, look, the new age companies' appetite has certainly improved quite substantially, because if you look at the listed cohort which is out there in the market, that has all done very well. And it has done well not just because the flows have been good, but because the operating performance for companies has really improved dramatically. I'm talking about like Zomato, Policy Bazaar, and others. So to that extent, that has really increased the appetite for investors to evaluate stories in the consumer tech space with the new age cohort. This is a segment which is quite underrepresented in the Indian context. I mean, the market cap would be, I would say, sub 2% for this cohort versus generally 20% plus when you look at US or China or other larger markets. So there's a long runway for these companies to actually approach the market and be part of the listed ecosystem, and investors having them as part of their portfolios. The other thematic, of course, continues to remain that anything which is on the domestic consumption thematic or theme, so consumer retail, all of those sectors are the ones that are really driving or are going to be the sectors where we are starting to see IPOs coming to the market. I believe manufacturing is the other sector which is starting to see some green shoots around, starting to come to the public markets as well. So this year we will, in my view, start seeing some of the manufacturing companies also approaching markets and raise capital, which I think will be a good sign that they are able to raise capital from public markets.
Okay, interesting. So consumer, perhaps manufacturing, that's where we're going to see more of the action. Abhinav, what about the asking rate, the valuations? Because I think, 21, 22 were very interesting years because you could be loss-making, but the market was willing to ascribe a lot of value at the IPO time. Then the market beat down these businesses, and now the whole path to profitability has happened. So when you talk about some of the newer age businesses, not just internet, tell us, I mean, I don't know if people in the EV ecosystem, whether they're looking to come to the market right now. EV is the next hot buzzword, right? So any new businesses, non-traditional businesses, what's the chatter on valuations and profitability?
So number one, the market has primarily moved towards now profitability-based metrics. So investors are focusing on EV/EBITDA, price to earnings, growth-adjusted multiples. Whereas in 2021, a lot of these discussions used to be on revenue multiples. And fundamentally, I would argue that it's a much more balanced approach to arguing valuations between investors and issuers when it is on profitability-based metrics, which is now the case. And I think it just bodes well. What I am seeing certainly is that given that there is a longer visibility of growth for most sectors in India, including the consumer tech or new age names, investors are willing to look a little bit forward when it comes to these multiples. So instead of, let's say, focusing on just 1 year forward price to earnings or EV/EBITDA multiples, a lot of investors are willing to give the benefit of doubt to companies and even look at FY26 at this point in time, which is effectively a 2 year forward multiple. And that really helps in terms of finding that balance.
Oops. I think we've just lost that feed, but that's a really interesting point that Abhinav was making, that, well, at least the market's a great teacher, they say. So at least we've moved from price to sales to price to earnings, or price to, EBITDA, EV to EBITDA, those kind of valuation multiples where there is an E in the equation that's not entirely forgotten. Abhinav, I'm not sure if you can hear me, but if you can, great speaking with you. Thank you so much for joining in and enlightening us with some of those views. Thank you very much. You have a good day, and we look forward to another conversation soon. Thank you. With that, let's take a quick break. We'll come back on the other side for a quick note for our viewers before we take that break. A daily wrap of the top headlines will hit your inboxes before you call it a night with CNBC TV18's daily newsletter on LinkedIn, featuring the top 10 stories on markets, corporate updates, economic insights, and financial highlights. So subscribe now and get the CNBC TV18 edge.
Welcome back. IT is under pressure today. The Nifty IT index is down nearly 1%. Now, overnight, Salesforce report, well, it's recovered now, but at 11 o'clock, it was down nearly 1%, but there has been that intraday recovery. Well, I just want to give you a quick update. Salesforce reported their numbers yesterday, and the shares tumbled 20%. It was the worst day for Salesforce share price since 2004. The reason being, Q1 was a miss. Their Q2 guidance was lower than what the street was anticipating. Now, Indian IT companies also have built significant capabilities around Salesforce's CRM business. So CLSA says Persistent and Infy has the highest employee and revenue exposure towards Salesforce. Salesforce's guidance for this year at 8 to 9% compares with the 29% growth seen last year. And this guidance assumes that demand environment will remain unchanged through the remaining of the year. The company is seeing elongated deal cycles, a high level of budget scrutiny from clients, implying the discretionary demand remains under pressure, which is why CLSA is cautious on the Indian IT sector. They have a sell rating on LTI Mindtree and Wipro, and both these two have nearly a 5% revenue exposure towards the customer relationship management, the CRM practice that Salesforce typically does. So that's the IT update for you and the possible impact or the read-through from Salesforce's Q1 miss. So keep your eye on Persistent and Infosys. But the sector's recovering now.
I guess, that was a bit of a shocker coming from Salesforce, and the kind of market reaction in the US itself was very, very strong and stark. On some of that rubbing off on Indian IT. By the way, just move beyond, look at mid-caps. Some interesting movers here. Prestige Estates is having a very decent session, 4% up. There is some buying in something like a five-star finance. Yeah. There is Praj, which is looking very good after numbers, by the way. Praj is up about 6.5%, reacting to earnings. Sula is managing a 4% up move as well. So interesting takeaways coming through from the mid-cap market. Another point, by the way, Edelweiss is recovering today. Yesterday was that reaction to RBI's missive that came in through to Edelweiss's two different entities. Today there's a bit of a recovery from the blows yesterday. Okay, let's turn our eyes onto another stock, which is now down, by the way, 3.5%. I am referring to Zomato. Why are we focusing on Zomato? Because word is that Jio is, making its entry into the delivery space with Jio Mart. We all know Mangalam's joining in. Mangalam, we all know the kind of disruptor that Jio can be in any sector that it enters. Now, what's happening with Zomato?
Well, for starters, quick commerce is the buzzword. Everyone's talking about Blinkit, etc. What we forget is that Reliance had an investment in Dunzo as well. So do they have the capabilities? Do they have the investment? Most definitely. It was just a matter of time that more people would come by. And we had a conversation with DMart's Neville Narona as well, who said that QCom is the way to go for India itself. What's unintuitive is brokerages actually calling it out as an impact on Zomato itself, and as a result of which Macquarie has an underperformed rating and a target of 96 rupees itself after a big rally that we've seen in the stock from levels a little under 50 rupees itself. So, they're saying that competitive intensity is rising. JioMart will start delivering groceries in 30 minutes from the next month. They will initially provide services in 8 cities and expand to top 20-30 in phase 1. They continue to see downside to consensus forecasts and margins for Blinkit. And that's where the surprise is, because most on the street actually believe that their aspirations on Blinkit are lower than what the company is actually performing. DP Goyal himself has said that Blinkit, in terms of TAM and growth, could actually be a lot higher than what the food service vertical is. If there was any worry on Zomato, it would largely come on the food delivery business, where the street believes that there is some saturation that it has reached. Let's see how this pans out. More importantly, the back-end work that Blinkit has done, the reach that they have, at what pace can other players come in, and will that come in at the cost of margins for one person or the other, or will people like you and me continue to pay the convenience fee for the service itself, is the big question that we need an answer to. So let's see how that comes about. For Blinkit, it's actually started operations in Gujarat very recently as well. So they are expanding, and now competitors are coming into the quick commerce space as well. This place is going to be interesting.
Oh, that's to say the least, absolutely. That's a rather dramatic price target that Macquarie's put out. I just realized 96, right? They're talking about a 44% downside. pretty stark. And I guess maybe because of that, the market's taking note of it and perhaps an excuse to book some profits. Maglam, thank you very much for that. Zomato definitely in focus today. We'll take a quick break on that note, come back on the other side. Up next, we'll be speaking with Prashant Rao from Anand Rathi Investment Banking and talk about a report that they've come out with. And they seem to be quite bullish on the defense space. We'll find out more. Welcome back. You're with us on Trading Hour. Well, as promised, we are going to get a conversation started on the defense space. There's a Anand Rathi note which is expecting the Indian defense market to hit $55 billion, I believe, in value. We'll have some more numbers coming up in just a bit. We have Prashant Rao, Director and Head Equity Capital Markets, joining in from Anand Rathi Investment Banking. Prashant, thank you very much for joining in. So it's a pretty exhaustive note that you folks have come out with, talking about the growth in defense expenditure, the size of the market itself. Let's start with some of the headline numbers, the ones that really define the defense opportunity for the companies in the listed ecosphere.
No, thank you so much. And good morning to you, Surbhi, and thank you so much for having me here. So before we break out, let's put things into perspective, right? So now, in terms of the players in the ecosystem, if I need to break that down into three parameters, so you will have the component manufacturers, you'll have the sub-assembly manufacturers, then you'll have obviously the platform manufacturers or the assembly manufacturers. Now, when you go into each of these segments, the market sizes are large, right? When you are looking at a total, we predict the entire defense market to be close to $55 billion by 2035. That's a very large number that you're talking about. And then you start breaking it down. Now, the government recently on the import side has listed down several negative import lists. There are close to $130 billion worth of orders which have been placed for modernization of the fleet, which is into all the three cases of the Army, the Air Force, the Navy, and the Army itself. So when you're talking about these large numbers, and especially companies which are already there, you have the larger DPSUs which are doing really well, but there are several of these smaller private players which are coming into the forefront. And they have now, from a component manufacturing, now evolving into the value chain into a sub-assembly and an assembly manufacturing.
Prashant, morning. This is Reema here. So $55 billion is a very large opportunity, right, by 2023. What's the current size?
So if you look at it, see, the current size on the defense side, maybe, we'll have to work out the numbers. But even then, if you look at it, it'll be close to, let's take, for example, a $10 billion sort of a number. Now, but when you go into it, the current production, currently we are at close to 1 lakh crores that we had achieved in FY23. This number, the government has a very ambitious plan to reach to $5 billion over the next couple of years. So these are very large numbers that you're talking about on the defense production side.
Okay. You must have studied the companies too, right? And I'm not getting into a stock call, whether one should buy and how the valuations are looking at, but just purely from a listed universe, because there are multiple players across the various segments that you highlighted. Which companies have, have a track record of being able to execute, this opportunity which lies ahead?
So I'll tell you, when you're looking at the listed side, first of all, it's very underrepresented, right? You have the large DPSUs on the listed side, then you have smaller companies on the listed side. So when you look at it, you'll have to look at the order book scenarios of all these players. When I'm talking to you about $130 billion in fleet modernization, exports which are already at 20,000 crores, going to go up to 50,000 crores in the near term, imports which have been declining. So when you're looking at these, the order books of these companies then take precedence. And primarily, we are seeing Air Force being the highest component of this entire order book scenario. Then comes Naval, and then comes, the Army. So companies which are into all these segments are obviously going to do well. There are companies which are now coming into from on the drone manufacturing side, counter drones, as what we have seen in the recent episodes, the world has seen. So all of these, when you put together, you'll see growth in all these aspects.
So you're saying Air Force largest in terms of potential order pipeline, followed by Navy, right?
That's correct.
Okay.
So just to give you this one, Surbi, so the Navy has this one of reaching 175 ships by 2035. So that's a very large number you're talking about. And when you're looking at those numbers, when you combine the Air Force and Navy and Army put together, there is a huge potential, just not for assembly manufacturers. That's what I was saying. So when you're looking at component, now there are high precision components. There are hundreds and thousands of these components which are required, let's say for example, a fighter jet or a ship. And that's how it flows down to the smaller players in the industry.
Sure, got it. Prashant, absolutely no taking away from the opportunity that you just described, and those numbers are looking absolutely, fabulous and rather mind-boggling. Now, the question from an investor's point of view is what's left on the table to play? Because, listed stocks have run up so much in the last 12 months. A stock like Cochin Shipyard, for instance, is up over 700%. That's an 8 times gain in 1 year alone. So the worry is if someone joins this party now, are they likely to sort of get their fingers burnt?
So I'll tell you. So what's important is, so when you're looking at defense has always been in a sweet spot for the last couple of years, right? And a lot of these companies have surged close to 200, 300, as you are saying, 700% in some of the cases. But it's also important to understand post-pandemic, the market has also moved 50%, right? So, and there is obviously been an exuberance and a euphoria around the defense space, and hence you're seeing a lot of these surges happening. So in terms of PE multiples, most of them are trading in between, let's say, 40 to 140 times. You might see some sort of a correction happening, but these corrections are actually healthy. It basically then makes the valuations more rational and sustainable going forward. So, but once you look at the opportunities and the order book, so give you an example, HAL is sitting at an order book of close to 94,000 crores, some others at 76 and 50,000 and all those. So these numbers are massive, but the question is whether those executions of these orders start funneling down to their revenues. Once you see that happening, obviously the performance on the stocks will also go up. Now, so
absolutely. Yeah, absolutely. Yeah. So let me actually, ask you a follow-up over there. Which are the companies or which are the entities which are likely to have a better execution rate, right? Because at the end of the day, it is that E of the price to earnings, which will justify even higher multiples given the rally. So would it be large PSUs like an HAL? Is that where you have maximum confidence? Could it be private players, some of the smaller private component manufacturers that you alluded to?
So I'll tell you, so obviously the DPSUs, the large players are going to have a very sustained growth going forward. But you'll see those type of real binary jumps happening on the smaller players. So I'll give you an example. A lot of these private component players are, as I said, have now evolved into a assembly and a sub-assembly. Companies like, let's say, Paris, which are now making complete periscopes into the entire ecosystem. So that's a change which has happened. And you'll see a large number of these smaller private players coming into the fray for component manufacturing, high precision manufacturing. So all of them, so I believe it's going to be a mix of both a very large extent private players taking the cake in terms of the growth, in terms of revenue.
Okay. All right, Prashant, we will wrap it up on that note. Thank you very much. Good to have those insights and look forward to understanding more as we progress. Perhaps after the July budget, we'll have a better idea of the final defense spending numbers from the government, and then let's see how the market reacts to that as well. Thank you for joining in today and wish you a good rest of the day as well. We'll take a quick break on that note, come back on the other side with more on the markets. I think, in fact, we have Sudeep Shah of SBI Securities, actually, before we take that break, for a quick check and a couple of trading ideas as well. Sudeep, good to have you on. So tell us, very quiet as we're getting into the big event day, what would your trading calls be?
Good morning, Surbi. It's quieter, and that's quite on the expected lines ahead of the exit polls and the actual results next week. I guess most of the market participants would not be too aggressive right now in positioning themselves for the event. So what we are seeing is that, and even if you see in the last 3-4 sessions, markets have been a bit jittery ahead of all these events. And apart from the election-related event, there is the Q1 GDP data also, which would be announced today, as well as the monetary policy next week. So overall, from a Nifty standpoint, we feel now major support on Nifty lies around 22,380, 22,400 zone, where the 50-day moving average is placed. And after this correction in the past few sessions, we feel that Nifty could take support at this zone. And on the resistance front, on the upside, 22,700, 22,750 zone would act as a stiff resistance, and above this 23,100 could be witnessed. And
Sandeep, yeah, go ahead.
yeah. So see, Bank Nifty relatively has been outperforming in the past few sessions. Important support zone for Bank Nifty is at 48,400, where the 20-day EMA is placed, and below this 47,900 could be visible. So overall, 48,400 on Nifty and 22,350, 22,400 on Nifty could act as strong supports. From the stock-specific perspective, we feel that one should focus on large caps as well as quality mid caps. And within the large cap space, L&T as well as M&M looks really strong from a relative strength perspective. And from the mid caps, we've seen, despite there being this lot of profit booking across spaces, from the defense space as well as from the air conditioning space, BEML, Cochin, Voltas, they have seen some good buying from lower levels. So those will be our top picks for the moment.
All right, Sudeep, thank you very much for that. Today, you are seeing pressure in Hero MotoCorp. Bharti Airtel too has slipped close to about 2%. And keep your eye on Titan. Titan Analyst Day is currently underway, and Titan is up 1.5%. Yesterday, the stock was under pressure, but today it's rebounded a bit. Get into a break. On the other side, we get you excerpts from our conversation with Kamal Kishore, the Managing Director of Indraprastha The Gas. Stay tuned. Welcome back. Some mid-caps reacting. Prestige Estates is up close to about 1.5%. Today, I think post the numbers, Morgan Stanley today has raised the target price on Prestige to 1,770. They're saying the target price raise is based on a strong pre-sales outlook for FY25, though high gearing and low margin is a bit of a concern. But there is a target price increase for Prestige, and that's pushing the stock up. Another one, a small one, and that's Lux Industries. That one too is showing you a gain of close to about 3.5%. While the top line of the company was down 1%, the company has doubled its margins to 10.3% versus 4.9%, and that's driving an 85% jump in the company's profitability. So Lux Industries is reacting to numbers. But let's get you a short snippet from an important corporate conversation from the sidelines of the LNG India Summit 2024, where my colleague Sapna Das spoke to Kamal Kishore Chettiwal, the Managing Director of Indraprastha The Gas. Listen in.
The new entrants, their initial selling and distribution expenses, they are on a higher side because their sourcing plus the manpower initial cost is very high, and it becomes difficult for them to sustain the operations. Whereas for big entities like IGL, MGL and top three, if I speak, they can absorb some of the selling and distribution expenses and make it pass on all the benefits that is there in say sourcing CNG either domestically or imported to the consumer. Domestic allocation was going to CNG. Now that value is at 63%. So that's the 20-25% drop in domestic allocation, and that remains today the cheapest source of gas. So that increases the cost of gas, and some entities are able to pass on. Others, just to survive, they have to pass on.
Over the next 6 months, how does IGL look at the prices?
No, we feel that the current prices are very attractive for the consumer, and I mean, it will be difficult for smaller entities to operate at these levels. So we see that slight increase in prices going forward for some of the geographical areas.
The bigger players you're talking?
For everybody, because the cost of gas is going up. I mean, the cost of domestic gas is going up, and the RLNG prices are also firming up.
Okay.
Recently, we see the gas coming down to $8.3 per MMBTU level. Currently, they are at $12. So 50% increase in spot values also.
Okay.
So both the factors, but still we have to keep at a discount to the existing fuels, petrol and diesel. So that will be maintained. Only the premium may reduce.
Okay, all right. And with that, we're out of time on this edition of Trading Hour. Thank you very much from the entire team that puts this show together. Thanks for watching. And a halftime report will take the action forward.